For the last 50 years, one specific goal defined financial success for the middle class: owning the family home, free and clear. But the financial system that made that goal mathematically sound no longer exists. In 1971, the global economy shifted away from a gold-backed equity system and transitioned entirely into a debt-based monetary framework. Your grandparents saved conservatively and aggressively paid down debt because in their era, that strategy protected their purchasing power. In today's environment, applying those same rules creates a heavy opportunity cost that many homeowners don't recognize until it's too late. If you have surplus cash every month, you face a choice. Do you send that money to the bank to accelerate your mortgage payoff, or do you deploy it into market assets? Choosing the wrong path here restricts your liquid capital for decades. It is the difference between simply eliminating a bill and engineering wealth that lasts. When trying to make this decision, most homeowners ask tactical questions, like whether they should make bi-weekly payments or apply extra principal every month. Those questions focus on the mechanics. To find the right strategy, you first have to ask, why do I want to pay this off? Most people want to clear their mortgage for one of three reasons. They want the security of no payments, they want more monthly cash flow, or they want to build up the asset value in their home equity. The feeling of being debt-free is a powerful motivator, but feelings are not a financial strategy. To see what paying off a mortgage actually achieves, we need to move past the emotions and run those three reasons through actual mathematical data. Focusing on comfort while ignoring the math hides the true cost of the decision and the long-term impact it has on your overall financial position. Let's start with security. The common belief is that a paid-off home means you are safe from financial ruin. However, the mortgage is only one of 5 mandatory monthly payments required to stay in your home. Even with the loan gone, you still owe property taxes and insurance. You still have to pay for utilities, and you are responsible for the ongoing maintenance of the structure. If you drop your housing costs from $3,400 a month to $1,500, you have saved money, but you still need a constant stream of cash to keep the house. If you stop paying those taxes, the state takes the property regardless of your equity. Real financial security comes from having liquid income that exceeds your total cost of living, not just from eliminating a single line item. Because these mandatory costs never go to zero, a paid-off house provides a sense of safety that doesn't actually protect you if your income disappears. That brings us to cash flow. To understand this, we have to look at the exact mechanics of making extra principal payments. Assume you have a $650,000 mortgage with a 4.9% fixed interest rate. Your monthly payment is roughly $3,400. You decide to accelerate the payoff by sending an extra $365 every month to the bank. Here is the outcome. Your required monthly payment of $3,400 stays exactly the same. That extra $365 is now frozen inside the home's equity, and you cannot touch it unless you sell the property or refinance. By locking that money away, you are essentially earning the 4.9% interest rate you are avoiding. That is the only job that money is doing. Now, consider routing that same $365 into a liquid market asset, like the S&P 500. With a historical long-run average return of 7%, your money is compounding at a rate that already beats your mortgage cost. Over 30 years, the difference is staggering. Prepaying the mortgage saves you interest, but investing that same monthly $365 builds a liquid portfolio worth approximately $450,000. Maintaining liquidity and deploying capital at a higher yield mathematically outperforms the strategy of prepaying low-interest debt. Finally, there is the equity argument, the idea that the home is a long-term savings account. This view ignores a mechanic that works in your favor as long as you have the loan: inflation arbitrage. While your mortgage payment is locked at $3,400, the currency itself is being devalued every year. Over several decades, the economic weight of that payment drops. As prices for everything else rise, your fixed debt becomes a smaller and smaller portion of your total expenses. You are paying the bank back with tomorrow's cheaper, devalued dollars. Paying the mortgage off early destroys this advantage. It takes mobile capital and traps it in a stagnant asset where it can no longer hedge against inflation. In a debt-based system, holding a long-term, fixed-rate mortgage is a powerful tool for building wealth while the currency loses value. Ultimately, the right choice depends on your own risk tolerance and what you are trying to achieve. We can map these strategies across a spectrum to see where you fit. For the security-first homeowner, if debt causes you significant stress, paying it off is a valid emotional choice. You just have to accept the mathematical trade-off of lost liquidity. For most new homeowners, the balanced path is to hold the low-cost debt, direct surplus cash into market indices, and let inflation slowly erode the real cost of the loan. The yield optimizer stops prepaying debt entirely. They keep their capital mobile and aggressively use fixed debt as a hedge while investing in higher yield assets. True financial engineering requires your money to do multiple jobs at once. Varying that money in the walls of your home limits your future choices. Accelerating a mortgage payoff is a trade. You are giving up financial leverage and liquidity in exchange for emotional peace of mind. Adopting the engineer's mindset means shifting away from a defensive fear of debt toward a strategy where every dollar is deployed for its highest return. Wealth requires an intentional system that leverages debt and time to build assets that outlast you.